Hey, everybody. Welcome back to today's Market Explained. Today, we have a really special episode. There's been lots of talk about investing in energy and lots of talk about energy being even more and more important. We're talking of nuclear. We're talking of all kinds of different ways to increase the output of energy for computers and everything else. Um, of the most experienced oil men that we're going to talk to today, Richard Loomis at Eagle Eye. Their oil program in Texas. Richard's a tremendously experienced man. And then Jace Graham is the CEO of Rising Phoenix. And they also are participating investors in oil wells. And they're all available as investments on the 4-Star platform. And these are two guys I wanted you to hear from. So without any further conversation, we'll start out with Richard Loomis, and then we'll have an interview with Jace Graham, and hopefully we'll learn something. So enjoy the episode. Hey, welcome back, everybody, to today's Market Explained. And today we have one of two interviews that we're going to do with special oil men. And we have a gentleman with us today who's one of the top oil men in America, and his name is Richard Loomis, and he's with an oil organization called Eagle Eye. And we're going to learn a little bit about oil. Why do we invest in it? What are the metrics of it, and then how can investors do it? Richard, welcome to our show.
Well, thank you very much for having me.
Excellent. Well, good. Well, we were talking earlier about America's position as an oil producer, and I guess we're the number one producer still, aren't we?
We are. And just to give your audience kind of some context, I was the publisher of World Energy magazine for 15 years, and I was the host of World Energy television. And what we were really trying to do is bring people up to speed on what's happening, not only in oil and gas, but in nuclear and coal and natural, wind and solar. So these are all the streams that provide the energy to our economy. And we call this industrial oxygen. Without it, nothing happens. So the idea that you can't generate enough energy to perform in your economy is just not an option. You have to do it. Every year, the demand for energy goes up. We still have 1.2 billion people on this planet who have no energy in their homes. That's a problem. Yeah. Here in the United States, we have a really unique position. We are now the largest producer of oil on the planet. What does that mean? That actually means we are the swing player. Now, most of us have heard of, or maybe even participated in, the gas lines from the 1970s. I know I did. I was in the backseat. And, you realize what happens when energy is cut off. What's happening right now is kind of a renaissance in the global energy scale. We all heard about Saudi and about the OPEC guys and how they could bring the price up, bring the price down. Not anymore. Right now, the swing player, as we would call it in the industry, is the United States. But getting into the largest commodity market on the planet really has not been available to individuals until now. Right now, if you look at it, I mean, we see all the advertisements for gold, and you got to have gold, you got to have gold. But arguably, gold is a fraction of what the commodity market is for oil and gas. And we are headed to a natural gas market as well. But right now, we have an oil market, and oil is fungible, and the United States is the place. So if I'm going to invest in oil and gas, I'm not doing it in offshore Nigeria anymore.
Right.
And that has driven the majors into what we call the Permian Basin. The Permian Basin is in West Texas and southeastern New Mexico.
Okay.
That has become the largest basin on the planet. It passed Gawar 2 years ago, which is Saudi Arabia. So it's right here in our backyard. What has that done? That has driven the majors, Exxon, BP, Chevron, ConocoPhillips, are now the major operators in the Permian Basin. They do so because it has become kind of a manufacturing process. So
Okay.
the question should be for your investors is how do I get involved? Because these guys have already got it.
So, Richard, aren't prices up partially because the federal lands have been restricted under the current administration? What's your take on all that?
Anytime you restrict access, prices go up.
Mhm.
And historically, under Democrats, I mean, for whatever reason, the price of oil typically goes up.
Mhm.
That happens.
Mhm.
But what's happened in this current administration, they killed the XL pipeline. They've started restricting permits on federal lands. They're trying to restrict fracking. And what has that done? It has driven the majors, the big boys who are playing in this game, to private land.
Okay.
Private land is Texas, Mexico. So New Mexico, not Mexico. So, you really have to get on private land.
Mhm.
Let's look at the actual production throughout the United States. So if you look at it, it used to be if you wanted to get into hydrocarbons, you're going north, go to Alaska. That's where it's at. Not anymore.
Not anymore. Okay.
California is off the table. It has some of the largest reserves in the world. California is off the table. You can't go there.
Mm.
So where does that take you? Texas. Remember the TV show Dallas?
Yes.
Okay, so there's where we're at now. The difference is you don't need all the zeros in your bank account anymore. If you
Okay.
look at Dallas, and I forget the guy's name, but he was the family that was involved in that.
They
It
are.
used to be that unless you had multiple zeros in your bank account, oil and gas was just off the table.
Yeah.
You couldn't do it.
Mhm.
And even myself, I mean, when I looked at our oil and gas company, we launched it in 2007. We actually went public on the Australian Stock Exchange.
Mm.
Don't ever do that. That was a very bad idea. But now we're able to invest heads up, straight up with companies like ConocoPhillips,
Mhm.
companies like,
Big company.
big companies, but also private companies like Mewborn, which you
Mhm.
may not have heard of, or Matador. Here's an interesting case. Matador is in the oil and gas space. They're an $8 billion company. Only in the oil and gas space would that be considered a small company.
Right.
It's a big company. And so what we're doing, and what I think individuals are going to start to see, is there's a real reason to diversify the asset base. If you got stocks, you got bonds, you think you're diversified. That's still one asset class. If you are in stocks, bonds, and real estate, now you have two asset classes. If you are in stocks, bonds, gold, three asset classes.
Right.
If you are in stocks, bonds, gold, and oil, four assets. Now
Good.
you really have diversification. And what happens in the oil and gas industry, and this is kind of counterintuitive, demand always goes up. Doesn't matter what happens. I mean, we still have 1.2 billion people on the planet who have no power to their house. Granted, primarily China, primarily India. But if you look here at the United States, we have 350 plus million people who live here. And every year, the demand for oil, the demand for power goes up, never goes down. And we look at the current slate of renewables, and I love renewables, but the current slate of renewables can't meet the demand levels.
Mm.
We've just started seeing a renewed vigor going into nuclear.
Mm.
Great for us. I mean, micro nukes are a great idea. But when you look at actual solid investments, I think everybody's portfolio should have some oil and gas in it. There's no
Mhm.
reason not to. It is the largest commodity market on the planet.
Yes.
There's always been access.
So,
And
Rich, why is California off the table?
well, because California has put in laws, I call them an energy island. They
Mhm.
have put in laws that say you cannot develop oil and gas. In my family, I'm a sixth generation Californian.
Oh,
I'm equally far back in Texas. But we still own oil and gas leases offshore in Santa Monica. You're not allowed to develop. Out in Bakersfield, you have a company called Era Energy, and it is still developing out in Bakersfield. But just about everywhere else in California has hydrocarbons. You could literally throw a rock, from the Capitol in Sacramento and toss it out in the field, drill a well, and you will probably find oil.
Wow.
But in California, they won't allow that development. They just won't. They
Now,
have two natural gas pipelines going into California. You had 4 nuclear power plants. They shut 3 of them off.
Yep.
So in California, you have a real problem.
Mm-hmm.
They are like Alaska. They got plenty of reserves. They're not allowed to develop them. And if you look at offshore New York, the Haugen Field, which is, I guess it's about, 3 miles offshore in New York, has more natural gas than we have in Oklahoma.
Mm.
And yet we cannot develop it. It's off limits.
Interesting.
These are what we call self-inflicted wounds. But this is what drives people to Texas.
Mm-hmm.
Texas is primarily private land. I mean, owners of that land can do whatever they want. And that is what has driven the industry over here.
Okay.
Southern New Mexico, southeastern New Mexico, same deal. These are ranchers. And I don't know if you've ever been out there, but if you go to Pecos, Texas, and I have a direct connection there. My uncle owns a ton of land out there. When you reach the gate of his property, it's another hour and a half to get to the ranch house.
Wow.
There's nothing out there. It is literally sagebrush, cows, and very, very flat. But what it does have is hydrocarbons.
Underneath.
So when you go out and you look at West Texas, it's owned by ranchers. They got plenty of room.
Mm-hmm.
And when you have plenty of room and you have low surface impact, because a natural gas facility or an oil facility takes up very little room, you can do that on like 1 acre. And with today's technology, we can go down 2 miles and we can stretch 2.5 miles laterally, which is also what drives our opportunity, which is why Eagle Eye works. But what you're doing is you have a very low surface impact, but a very high energy impact. So the oil production has risen dramatically. And it's because of the contact along that horizontal line. Think about it. We used to do vertical wells. When you do a vertical well through 15 strata of geology, you got about 45 feet of pull where you're going to pull that hydrocarbon into the wellbore. Now you got 2.5 miles in the same strata. So we go down, 1 mile and go 2.5 miles that way. Now we're hitting that same very, very small piece, but we're hitting it for 2 miles.
Wow.
And that is what makes the oil and gas industry so expensive, but also so profitable.
Yes.
And what we've done with Eagle Eye, which is a little interesting, and I'm going to deviate just slightly on, I know you had an interview planned, but here's something fun. With Eagle Eye, we are looking at how oil and gas is actually developed. Mm-hmm. So if you look at it, it's a grid. I mean, the federal government and the state government puts up a bunch of squares over the map. Those squares are what we call drilling blocks, and they're different sizes in different states. But whoever owns the majority of the rights to drill on that square, they're the ones who dictate the price. This is what makes this strategy interesting, because that price doesn't change. It's the same at $50 oil or $100 oil. Same price. Drill a well. So what Eagle Eye does is we look at the majors, Conoco, Matador, Chevron, BP, ExxonMobil. We look at their drilling schedules. Which blocks are they drilling on? Then we look at who are the minority interest owners on those blocks. And a minority interest owner only has 2 choices. Participate, don't participate. Well, there are a lot of reasons why a minority interest owner wouldn't participate, but the biggest reason is that the cost has gone up so dramatically. And most minority interest owners don't have that many zeros in their pocketbook. But when we talk to the minority interest owner and we say, are you going to participate or not participate? Give them a third option. If you're not going to participate, we're going to make this to your benefit, and we're going to buy it, or we're going to come up with an arrangement to take that minority interest over. And as Eagle Eye, what we do is we take those small percentages in those wells. So the actual person running the well is ConocoPhillips. It's their job. They're going to drill it. They got the best geologists, the best rig rates. They can do it for less money than anybody can. We're going to take our small percentage of it and we're going to give that to the individual investor. That comes with a couple of things that nobody anticipated. So when you do that, not only do you get income, but you get the same tax advantages that the major gets. So this is what had Congress all upset 2.5 years ago. Why are we subsidizing the oil and gas industry? There's a reason. It's industrial oxygen. We need it. However, when an individual can take advantage of the same tax breaks, it's pretty impressive.
Very impressive. Yes.
So an individual can invest 100 grand in the oil and gas industry, and they can reduce their taxable income by 70 or 80% of that investment. So, and it's not just us. There are other companies doing this, but there aren't that many that individuals can access. Usually the demand, you have to put too much money in. You need to have such a large number of zeros on your checkbook that this was the home of private equity. This was the home of wealth offices. Now, with the changes that have come about, we're able to offer this to individuals. So if you invested $100,000 with our company last year in 2023, you could take 90%. So $90,000 reduction in taxable income. So if you're a W-2 employee, you went from $500,000 in income to 400. So it's a significant way to not only help the country, we need every bit of energy we can get our hands on, but you can also help yourself.
Right.
I think when you do well by doing good, that's an advantage for everybody.
Absolutely. Hey, question for you. We talked about Texas, New Mexico, probably a little bit of Oklahoma, I suspect, but what about North Dakota? What about Illinois? I know they drill in Southern Illinois. What about Tennessee? There's other oil markets around. Are those viable? Are those?
Absolutely. I mean, here's what you look at in the oil and gas industry: lifting cost and break-even cost.
Okay.
Those are the two things you're after. So the lifting cost is the incremental cost of getting a barrel of oil out of the ground.
Out of the ground.
And then you look at the break-even cost. The break-even cost is what BP is paying to run their operations, or what Chevron is running to pay for their operations in the location. There are probably 8 different basins around the United States, and they're all good, but they all have different break-even costs. You mentioned North Dakota. The break-even cost in North Dakota is about $70 a barrel. That's what you need to break even.
Okay.
If you look at Saudi Arabia, that break-even cost is almost equivalent, $70. The lifting cost to get an incremental barrel out of the ground in North Dakota is about $40. The lifting cost in Saudi Arabia is $12. Yes. Now, that's one of the things that we look at in the industry. So you want to go where the break-even cost is the lowest and the lifting cost is the lowest. In Permian Basin in the Delaware, which is where we play, the lifting cost is $12.
Okay.
Break-even is $42. It is the lowest cost in the entire country. So when we're seeing prices where we are right now at $70, $75, $80 oil, just about everything in the United States works. But as an individual investor, you want to go where the lowest lifting cost is and the lowest break even, because then you're making money no matter what. That is the Permian Basin.
Okay.
The other side of that is that the Permian Basin is the home of the majors.
Mhm.
So, I mean, you really want the guy that can negotiate the best rig rates, can have the best geologists and the best engineers, and can provide you with the best performance.
Right.
That's going to be Chevron. That's going to be Exxon. That's going to be XTO, which is part of Exxon. And you're going to be at, ConocoPhillips, and you're going to be with private companies like Mewborn, which has its own investment opportunities.
Right.
But without that, it's a coin toss. It still is, whether you're going to get a dry hole or you're going to get a productive well. There is a saying: if you're going to find oil, go where oil already has been found.
Right.
That's the obvious one. And then the other thing that they talk about is, and I don't know if you know this, but do you know what the most profitable company on the planet is?
No, I don't actually.
It's an oil and gas company.
Mhm.
The second most profitable company on the planet is a poorly run oil and gas company. And, that's kind of funny, but
Yeah.
that's the way this works.
Mhm.
And so when you look at something like like oil and gas, and you're coming in as a non-operator, which is what we do. We're not trying to operate. We don't want to compete with BP or with Chevron. We want them to do all the work. We want the benefits. And in the oil and gas business, we call that mailbox money. And what we do is we pay our piece of the expense, but we get all the revenue to our percentage of the production. But that's mailbox money.
Right.
Do you want Joe Bob's Oil Company running that, or do you want XTO? And
Right.
the answer is you want XTO. They have the best geologists, the best engineers, the best rig rates, and the best crews. They go out and they drill entire manufacturing operations in the Permian Basin, which is the largest basin on the planet. That
Interesting.
makes a whole lot of sense. Now, there's a bunch of stuff you could be doing. We call that a science experiment. The Bakken, without George Mitchell, the Bakken would not have worked. And Mitchell Energy is, really a pioneer in how you get things done in tight shale. They did the Barnett Shale in Texas. They figured out how to do the tight sands in Canada. They figured out how to do the Bakken. That's not where an individual wants to play. Let them do that. That's what they want to do. What we're looking at is being able to invest in the largest commodity market on the planet, but not the science experiment. You want to do this where it's already been done, and you're riding along with people who know how to do it.
Exactly. Well, God, it sounds like a great opportunity. Um, what do you see for the future in the oil market? If oil prices go down, it's hard for oil to be, a good investment, or do you think they're going to go down?
Well, we don't know what's going to happen with oil prices. And I
Mhm.
always used to say oil prices go up, they go down, they're never zero. We actually saw them go to zero thanks to COVID.
At
So,
one point,
yeah.
yes.
So stuff happens. But anytime somebody is looking at investing in the largest commodity market on the planet, you have just a few things you need to know. You want the lowest lifting cost,
Mhm.
incremental cost getting out of the ground, and you want the lowest break even. So if you have those two things attached to your investment, the likelihood of you making money is much, much higher. And
Right.
then what you really want to do is there are a couple of ways to do this. You can invest, you can buy stock in Conoco, you get a dividend. You can buy minerals rights, which may or may not be produced. Or you can look at it from our direction, which is we want to know who's drilling now, where are they drilling, and then what is the AFE, the cost of drilling, not the cost of the reserves in the ground, the cost of drilling.
Mhm.
That's what makes the current way that you can invest in oil and gas much more profitable because you're basically buying the same thing that a Mewborn is. There you've got all the overhead associated with it. They're investing in the same well, and they're going to give you like a 1.5 percent distribution every year based on your stock position. That's
Mhm.
great. Good for them. But
Yeah.
what we're doing is we're saying you're going to get 15% or better investing in the same well. Kind of like, remember the cellular companies? They do all these advertisements, which are
Right.
fun. says same network, same service, less cost.
Right.
In our case, same well, same company, you just get more money.
Right.
We're investing at the wellhead. So this was not available before. I mean, this is kind of new. And there are a few companies that are doing this. And what it's called is a non-operating working interest.
Mhm.
It's not new. It's just it's never been fractionalized to the point where somebody could come into the investment without having $10 million
Mhm.
or $20 million, which, by the way, those are very small investments in the oil and gas industry. So if you look at the number of zeros it requires to play in this game, most people would back away from it. You'd say, no, can't get there. I love it, want it, can't do it. Now we can. And this is, I think, what makes your company unique as well, because this is something that your investors can actually tap into, which I don't know of any other RA in your space that can do that.
Yes. No, we're very fortunate. Well, we appreciate that. Of course, this is not necessarily an offer to buy or sell. So every investor needs to look into their own portfolio and work with their financial advisor to see if this is right for them. But it certainly is an intriguing opportunity, certainly.
Well, and it comes with not only income, but tax benefits.
And then tax benefits, yes.
And that requires a tax professional to look at it, see if it works for you individually. I know that. But
Right.
here's what I find interesting. The biggest companies in the world do not pay taxes. The individual doesn't get that opportunity. In this particular instance, you get the same advantages of an XTO, a Chevron, or a BP, or an ExxonMobil.
Mhm.
It's identical. You get to take advantage of what are called intangible drilling costs, which are going to give you that 70 to 80% offset in the first year. You get to take advantage of what are called tangible drilling costs. Those everybody gets. That's the same thing as bonus depreciation or depreciation period. It's hard assets on location. You also get to take advantage of what is called a depletion allowance because these are depreciating assets. So the first 15% of revenue you receive from the oil patch is tax exempt. So you're only paying tax on 85% of the income you receive. So when you add all this stuff together, you have a strategy that'll let you take advantage of the largest commodity market on the planet. It will let you take advantage of some of the very best tax incentives or a tax reduction strategy that the majors have been using since 1913. And then you get to take advantage of the overriding income and demand, which we know is never going down. Whether the price goes up or it goes down, we are still going to use hydrocarbons for the foreseeable future.
Interesting. Well, great. Well, thank you, Richard. We're coming to the end of our show here. Is there any last message you'd like to leave everybody with?
Well, the main thing is if you are invested in oil and gas, go to the gas pump and it costs you $4 to fill up your tank, $4 a gallon, you're going to feel a whole lot better about it because you have this kind of hedge. And I always look at it this way. You want to be diversified, but you want to be in different asset classes. So this allows an individual investor who never could have touched this asset class before. But what we're doing and what we're doing with you allows an individual to get into this with reasonable prices and take advantage of things that have been here since 1913. You just haven't touched it until now.
Nice. Well, that's great. And you're obviously great knowledge of the oil markets and learned a lot here today. So thank you for your time today, Richard. Really appreciate it.
Well, thanks for having me on.
All right. Well, thanks everybody. And we will be back again with Richard at another point in the future, but let's look at possibly investing in oil if it's the right thing for that investor. So thanks again. Thanks for being with us. Goodbye, everybody. Hey, welcome back, everybody, to today's Market Explained. Here's the second half of our interview program where we're talking all about energy and specifically hydrocarbons and oil. We have a real oil man here with us today, Jace Graham. And Jace is the leader of Rising Phoenix. And welcome to the podcast today, Jace. Glad to have you.
Brian, appreciate it. Look forward to jumping in and talking about what we love the most, oil and gas and energy.
Absolutely. Well, and we're the largest producer of oil and gas now, still, aren't we?
Yeah, United States is definitely leading the forefront on not only oil but also natural gas. I mean, we've got quite a bit of natural gas reserves and through all the different various shale plays, but also oil is a massive exporting opportunity for us, but also we use quite a bit of it domestically. So yeah, we're number one in both categories.
Right. And I think, the government, this current government is restricting federal lands, but there's just enormous activity going on private lands, right?
Absolutely. Yeah. I mean, it's always been the case. I mean, obviously the federal lands, depending on who's in office, sometimes they curtail the leasing activity on that stuff. But yeah, I mean, in the United States, the Permian Basin is the mothership. It's the gift that keeps on giving. It's been going on for a better part of 100 years and multiple layers, multiple zones. Where some of these other basins, like let's say the Barnett Shale or the Haynesville Shale, there could be just one primary zone that operators are going after. The Permian has got as many as 8 to sometimes 12 different zones that you can go after and produce oil, natural gas, and what they call liquids, which is kind of in between both of those.
Mhm. So, Jace, we've talked about a bunch of different subjects, and you obviously are involved in oil and the investing in oil projects, and then also natural gas, right?
Correct. Yeah. Like I mentioned, oil is, we look at coal as the energy source of the past. Oil is the energy source of the present, and we see natural gas. I mean, we got 80 years of reserves that we've not tapped into as of yet, still in play there, and it's a cleaner resource. So a lot of room, Brian.
Great. So why would we look at all this now? I mean, oil's been there for 100 years. Is there a particular inflection point today for people to look at investing in oil-related programs?
Well, I mean, I think you got to look. I mean, energy is everywhere, right? When we talk about energy, just how are we utilizing oil and natural gas today? Obviously, the first and foremost, everybody knows about transportation, cars, gasoline, you name that. But there's just so many other things that petroleum is utilized for. I mean, from plastics to roads to fertilizers to medical equipment. I mean, there's just so many things. We're so integrated in using those types of things. But I think today, especially as we're kind of moving into this world of whether it's electric vehicles, the EV vehicles and whatnot, natural gas is a primary fuel source to generate electricity. So these coal-fired plants are kind of coming offline. They're not in favor and getting replaced by natural gas. And so, see long-term viability on that for the long foreseeable future. So, today it's kind of an interesting scenario. You've got, oil hovering around 70, $75 a barrel, which is kind of a good supply demand economics where we can see that kind of sustaining that. But, you've got all this, turmoil and whatnot going on overseas with, that could affect OPEC and the output of supply there, where, you could make a case and for $100 oil in the not too distant future. On the flip side, natural gas is at 5-year lows. So it's hovering around 250 an MCF, million cubic feet is how that's traded. And we think it's a phenomenal time to buy, knowing that, demand will continue to increase, primarily through these LNG facilities that are starting to export liquefied natural gas to other countries. And they're coming online. A lot of them are coming online in 2026. So great time to come in and try to, take advantage of, that price arbitrage, buy low, sell high component on the nat gas side. But oil is, it's at 70, $75 a barrel where we're at today. I think it's a great buy.
So what if oil prices go down? Are we not going to be profitable? Or and do you think that might happen?
You know, I mean, I'm not gonna say it won't happen. It has happened. It doesn't stay down there very long. I do know that, just looking back in history. Um, and so, I think you got to look at this, the investments that you're getting into are these short-term investments, meaning, 1 to 2, 3 year horizon type stuff. I mean, the oil and gas mineral funds that we have at Rising Phoenix, we're looking 3 to 5 years out. We're kind of factoring in and hedging some of the pricing. So the price volatility. So if price is at 70, $75 a barrel, we're pricing it at 50, maybe $55 a barrel when we make offers. So we're kind of factoring that into our overall pricing. But
Okay.
yeah, I think if it goes down, you're going to see that on the yield back to the investors. But again, it's been kind of more of a temporary. We can go back and point to our track record since 2017, and we got drugged through that COVID era where oil was trading in the futures at a negative. We never saw that on check stubs, but we definitely saw $20-$25 oil, and you'll see your yields drop to maybe 4, 5, 6% cash on cash, which I don't see that as. I mean, it's not a worst case. We're not losing money. It's always going to be generating some sort of income. It's just that payout will be extended.
Okay. So Jace, what about competition? Like, doesn't Russia drill? They've got a big oil reserve up there. We've got Saudi Arabia, but even with all that, we're still the largest producer in the world, right?
Yeah, I mean, oil. When we talk about oil, remember, it's sold on the international world market to the highest bidder. So just because we produce it in West Texas doesn't mean it gets sold in the United States. That's the difference between oil and natural gas. Natural gas has been typically restricted by pipeline within the domestic U.S. Now that we're starting to liquefy natural gas and export it, it's starting to change the game a little bit. So yeah, even though we are a top producer, we're selling to the highest buyer across the world. So don't see that slowing down. The Permian, like I said, continues to just produce phenomenal amounts of oil to the market, which keeps gasoline in check at a price point that works, and a lot of other things behind it.
So there are other areas in this country where there's oil available and drilling up in the Williston. There's Tennessee. I know there's groups that drill in Southern Illinois. Are these areas meaningful, or is it still primarily just the Texas and New Mexico? And
No, there's the shale revolution occurred back in the late 90s, probably early 2000s. And it started in the Barnett Shale, which was all natural gas. There's a gentleman, Mitchell, that I kind of was doing the horizontal drilling back before it was cool, and then kind of discovered that the field had been there forever, but this shale it's a very tight kind of formation that you have to drill horizontally through and then fracture and open up that rock so that you can get the hydrocarbons out. With the discovery and development of the horizontal drilling in the Barnett Shale, it's opened up all these other shale plays. There were always the operators and geologists knew that they were there. We just could not effectively extract that oil or natural gas. Now we can, which has been phenomenal for the United States. I mean, we are energy independent for the first time because of these shale plays. So we're not relying on foreign oil. We're not relying on foreign energy per se. So that's really kind of changed the narrative a bit, where we can kind of stand on our own and actually export now.
Wow.
So, but those basins, the Williston, which is, you got the Bakken, the DJ, the Marcellus Shale. I mean, we own assets in every single one of these basins, and we like owning assets across multiple basins. We like to be diversified within our portfolio. So we're not just, heavy in one certain basin or the other. Plus, the last thing I'll add is some of these other basins that may not be as sexy or as in favor as, say, the Permian Basin, which everybody knows about in West Texas. You can get really good value add opportunities because you don't have a bunch of private equity chasing, those types of areas like they do in the Permian, where prices are just getting bid up to where we can't make sense to always, acquire down there. So
Interesting. Okay. Well, uh, you've heard about all the people that don't like oil and they want to restrict leases and everything, but that's really been mostly on federal lands, right? It's not really been private. Has that really affected the market that much?
I mean, you've seen some moratoriums, from a, more local level. The state of New York was, banned horizontal drilling and fracking altogether. Now there's quite a bit of case law that I won't go into that you really can't do that, because in the United States, the mineral interest take precedent over the surface. So you can't, allow people not to have access to their minerals. But from what you're talking, I mean, if you're restricting supply, which is what that does, demand continues to just increase even through just sheer population growth. Price is going to go up, and that's the offset that you see is, when they come in and say no more drilling on federal lands. Okay, great, everyone's high five, and all of a sudden gasoline goes to $6, $7, $8 a gallon. The crowd is a little fickle at that point, and all of a sudden now they're starting to allow some drilling and leasing on federal lands. Same, same president. So, like I said, I think it's, where does it hit the consumer, and it hits him really hard, in the pocketbook on not only transportation and gasoline, but also just electricity cost from just how do I keep my electricity going, and why is that price so much higher when natural gas goes up? So, like I said, the shale plays and the shale revolution have allowed a large supply of oil and natural gas into the market, which has stabilized and dropped pricing. And without that, prices would be really, really quite high. And so if you ban off fracking, I would be sure that I own minerals, because price is going to go through the roof. I don't want that to happen. If it does, Brian, I'll be flying up on, my own G5 to your office next, because it would be a huge payday. But just because price, it's just a supply demand component that goes on. And I think just how things are regulated, these operators are highly regulated on how they drill and develop these wells to ensure that there's no contamination or pollution or any of that kind of stuff. I mean, there is some sort of a byproduct of that. It goes along with it. It's just part of it. But I think the operators are doing a phenomenal job domestically of maintaining that integrity with these well bores and what they're doing with them.
Now you talk in terms of the word minerals. So the minerals are actually what, the actual oil reserves or the gas reserves, or that's just a general term for everything?
It's generally everything. So when you own a piece of land from the first president that deeded you the land, right, from sovereignty, you own, from what they say, from the center of the earth to the zenith in the sky, all right, title, and interest. Okay. And, the mineral interest is what's below the surface, all the way to the center of the earth. And so you can have, water rights, you can have, coal and all that. But what we're talking about when we talk about minerals in the oil and gas world is the true oil and gas mineral rights that are sometimes 2, 3, 4 miles below the surface, generate, oil and natural gas.
So the fundamentals of the oil minerals business is pretty strong, and you think will be strong for a long time. Short-term prices notwithstanding, the general trend is positive.
It's not going. I mean, just the infrastructure alone is just massive. We look at it. 33% of our production or energy comes from natural gas, 36 from oil. Only 13% total, comes from renewables. So that's wind and solar that make up that, and even some hydro component. So, I mean, it's here. We talk about like the electric. What about the EV vehicles and battery and all this stuff? Well, you got to. What charges that? Where's the electricity come from? It doesn't come from nothing. It actually comes from a lot of natural gas. and like I said, just the amount of petroleum we use, not in just gasoline, but just all these other products. It's gonna be around for a long, long time.
Okay, great, great. So, all right, so if the long-term investor can add minerals, through oil and gas programs to their portfolio, what are the ways to do it? Like you buy a partnership, and that's what you offer, right?
Correct. Yeah, we do direct investment, so we've got a phenomenal boots on the ground team. We're picking up the phone and talking to hundreds, if not thousands, of mineral owners every month across the country and trying to see if they'd be interested in taking a lump sum payout for their monthly cash flow that they're getting from these wells or this well or wells. So,
Okay.
and we've got an in-house petroleum engineer that's underwriting these assets, so we know that what we're buying and we know what that future cash flow looks like. But yeah, it's a nice, quiet mailbox money per se, monthly distribution. We get royalty checks into the fund every month. You're diversified across multiple basins, and thousands of wells, and we do distributions out, and we've had a pretty decent track record. Since we started, we've been averaging about 17% cash on cash since inception. So if we don't do anything, we don't sell these assets or at all, we're expecting, total payout to our investors just based on the cash flow alone within a 4 to 6 year period. And our funds have done that.
Okay. So then you get your investment back through income, and then is there anything on the back end, like you sell the wells at some point to someone else? Okay.
Right.
Tell me about
Exactly. Yeah. I mean, what we do and just how we do it, a little scrappier, right? Boots on the ground, all that, picking up 200, 300, $500,000 assets. There's a market where once you get to scale, these larger private equity companies that 500 million, $1 billion, and that they've got to deploy in an 18-month period, they want to buy something that's in a nice, neat little package. And so that's what we look to do, is aggregate our assets and then take them to market, and sell out to a larger fish.
Okay. And who are those folks? Like who would buy our interest?
So a couple of, just well-known groups. There's even a couple of publicly traded companies. Kimball Royalty Partners is one, publicly traded company. Dorchester is another one that acquires these types of assets. On the private equity side, there's a group, NGP, Natural Gas Partners, and NCAP are the two big private equity-backed firms that have 2 or 3, if not one of them has, I think, 4 individual mineral buying arms that go out and acquire minerals and royalties that, they've got a mandate to deploy a minimum of 250 million. So those types of groups that are not going to do the heavy ground game, they've got to deploy capital and they got to deploy a lot of it. We make a good fit for them, to, acquire the assets that we've kind of accumulated and find value add, done distributions to our investors. And then, like you said, do an exit, towards the end there.
Excellent. Okay. And how long is that usually? Is there a range of years that we will get an exit out of it?
Yeah, I mean, we're shooting for a 2 to 4 year hold. Okay.
2 to 4.
On our mineral funds.
Okay.
Like I said, if we don't, and we have some funds that we have not sold, one of them, was kind of placed around the COVID era, they're going to pay out on their own, within a 5-year period. That's a 20%, cash on cash return. But no, it's a good asset. We look at a 1.5 to 2 to 1 multiple on invested capital, a MOIC. So you
Okay.
put 100 grand in. Our goal and what we're shooting for is $150,000 to $200,000 back to our investors. That's inclusive of distributions within a 2 to 4 year period, and 15 to 20% internal rate of return. If we don't clip that, I ain't doing my job.
Okay. So those are projections of what's happened in past programs. And of course, we can't guarantee that, but that's kind of a real target, right?
Right. And we've worked with Mick Law. You're familiar with Mick, Brian. They underwrite our offerings, so they're fact checking everything that we have out there. They're looking back at prior performance. They're looking back at our reserve analysis to see, does this make sense? Is this within reason? Is this real? And we got a very favorable Mick report, which obviously Brian put us in touch with one another.
Absolutely. And for those folks who don't know, there are organizations that do dig into all the details and all the programs that folks are investing in. And Mikla is one of those groups. Mikla is out of Omaha, and they have a report, and we can get anybody that report if they want to see it. But well, this sounds really exciting. I mean, the natural gas angle is really interesting. There is a crowd of folks that want electric cars, and they're pushing it, subsidizing, doing all this, and it's to get rid of fossil fuels. But in fact, natural gas is used to produce electric, so they still need natural gas, right?
Yeah, it's exactly right. And like I said, the renewables, just without the subsidies and the help from the government, it's just, especially with natural gas at $2.50 an MCF, it's not economical.
Right.
And so it's here. I mean, we're producing 100 BCF of natural gas a day domestically. We export currently about 25% of that LNG. But there's some things that are also coming up that that get me excited about owning natural gas today at $2 to $3 an MCF. Number one is, I'm sure you're aware of all these AI data centers that are starting to pop up. Okay, they take tremendous amounts of electricity to run these data centers, and this is going to continue to grow. So that's an area that, if you would ask me 5 years ago, where do I see the demand coming from? That wouldn't have been on the radar.
Yeah.
Number two, there's quite a few large LNG, liquefied natural gas facilities coming online around 2026. Okay, where demand is supposed to increase by another 30 BCF a day from these LNG ports that are typically around the Gulf of Mexico, Texas, into Louisiana, that are going to be coming online, that are going to be pulling a lot of natural gas down and exporting it out. So demand will grow, and it will grow somewhat exponentially because of some of these new areas that are pulling on natural gas, as a product. So
Okay. Great. So, tell me a little bit more about the foreign oil markets. How do they work, and how do they affect us or not? You said they didn't much. A little bit more.
I mean, obviously, OPEC is a big group. Obviously, it's several countries that have kind of pooled together. In fact, to kind of compete against the Permian Basin, West Texas. Obviously, with their pooled strength together, I mean, they can kind of dictate a little bit of what happens with price. So, as we all know, there's quite a bit of geopolitical issues going on in the Middle East. There could be some restrictions, or even complete stalls in production over there that could we could see price increase over here. We do import oil. Even though we produce the most, we do import oil, and in our primary country that we import from is Canada, believe it or not.
Canada.
Yeah, with the heavy crude. So yeah, I mean, what's going on overseas definitely can affect price. Again, I don't see it being long term, but if there's a war in the Middle East, and you're around one of those countries that produces a lot of oil, and they are having to restrict that output, price will definitely increase. Which as a mineral owner, we're okay with that. I mean, we like that. If I'm going and I'm filling up my car at the pump, I don't like that. So I guess it's our hedge against gasoline prices. But
Against your gas list to buy some energy investments, right?
yeah, I guess it eases the pain a little bit, right?
Pain, that's right. And I remember I was a young man at the time, but in 1973, the oil embargo, when OPEC did their thing, and they had a stranglehold on oil at the time. And I think West Texas Intermediate crude was $3 a barrel, and overnight it was almost $20 a barrel.
Yep.
And that'd be the equivalent of oil going from where it is now at $70 a barrel to like $400 or $500 a barrel, like overnight, right?
Right. I think the biggest Yeah, I mean, I think the biggest differentiator between that time and now is just the horizontal shale plays that we've
Mhm.
developed. I mean, like I said, we now are energy independent, when back then we were relying on foreign oil quite heavily. So when something occurred over there, it would definitely affect us. Now we kind of can dictate what we do over here, and our domestic operators are phenomenal. They are starting to kind of figure this whole thing out as a group, to be able to, that no one really likes all the big swings, right? And so, if oil's at a price point that makes sense, they'll drill, but maybe not, drill, baby, drill, like don't go crazy.
Right.
But let's do this in a way that we don't hurt each other, and maintain a level a price level that where we can all make money. But yeah, you're seeing that kind of happening in the Permian as well, with operators kind of coming together and restricting output based on where pricing is, or increasing it.
Exactly. Well, good. So it's good to know that we're not going to have on the offing, we're not going to have another oil embargo and another explosion in price and all that. So things are different, and technology is different and all that. Horizontal drilling, that's a really interesting development, isn't it?
I mean, it's a game changer. And it was, done kind of right in our backyard,
Yeah.
where I'm from, down in Dallas, Texas, with, what Mitchell did in the Barnett Shale.
Mitchell Energy, that's the company, right?
Mitchell Energy ended up selling to Devon, but yeah, he was the gentleman that, was the one that kind of revolutionized the way that this was done, and drilling into these horizontal, very tight sands. 'Cause normally, if we drill quickly down into a very tight sand and kind of stimulated it around there, you'd only get just right around that wellbore. If you drill
Mhm.
horizontally all the way through it, just imagine, I mean, you're getting that much more exposure to that reservoir, and then stimulating it, and then you're able to pull that much more out. So that's where they really changed the game. And there's thousands and thousands of horizontal wells today that allowed us to be, like I said, energy independent, not worrying about where our oil is coming from and natural gas. So again, the United States is not a bad place to live in.
Yeah, absolutely. Well, that's great. Are there pure plays in gas as compared to oil? And
There are
how would you view that?
There are some, very what we call dry gas.
Mhm.
There are some dry gas plays. Barnett Shale is one of those.
Mhm.
The Haynesville Shale, which is in Louisiana and kind of borders into Texas, is another one. The Marcellus Shale up in the Northeast, which is what we call
Mhm.
Appalachia, um, is a more dry gas formation. And then there's a whole little band in the Eagleford Shale, which is kind of South Texas, that has a dry gas component. But I'll add, Brian, I mean, natural gas, about, these wells in the Permian Basin we keep talking about, the heavy oil wells, you know, 30% of their production is natural gas. And so what
Mhm.
we've seen here with natural gas dropping is because we've had this oversupply of natural gas because of all the oil drilling in the Permian, and the natural gas is a byproduct. And so it's flooding the market. They're drilling for oil, making good money for oil. They could almost give the gas away in the Permian because they're making their money based on the oil. But it's flooded the market here in the United States with, an abundance of natural gas. It's good for the consumer, but it's also dropped price. Again, I like where it is right now to buy minerals, because I know that demand, like I said, through, just sheer population growth, through, increased LNG capacity, and even data centers coming online, is going to continue to grow. And this all oil and natural gas, it's a finite product. It's not just, there's just an endless supply of this stuff. So there
Mhm.
is a, declining component to these wells when they're drilled. And so I think it's 250 today. It's got a lot of room to go up, not a lot of room to go down. So it's never going to
Wow,
be.
very interesting. Well, good. There's a number of ways to play it. And so you can invest in direct programs. Four Star has a diversified alternatives fund with an energy investment sleeve. And many of the programs, including yours, appear in that now, in the current version of that. And so there's plenty of ways to play it. And so we'd like every investor who's interested to talk to your advisor. If you'd like an advisor at 4-Star, we can help you with that. But we're very fortunate today to have Jace with us as one of our top experts in the industry. Jace, is there any other message you'd like to leave our potential oil investors or listeners today?
No, I mean, I enjoy the conversation. I just think, like, when you're looking at your entire portfolio, having some exposure in the energy markets is good, directly, and not investing in maybe, the stocks of energy companies. So having some access to some alternative assets, and in this space, you can play it from a drilling and completion side with, big tax write-offs and whatnot, a little riskier. Or you can kind of also look at kind of the mineral stuff that we do heavily, as a I'd say a safer way, where you're just buying the passive revenue stream of hundreds, if not thousands, of wells across the country.
Right.
And if you like mailbox money, it's in quiet. We think it's a pretty good investment. So we'd welcome the opportunity to talk to anybody. Jonathan Nickel on our business development team is great at answering questions, and I'm available as well. So Brian, I really appreciate the time, and think oil and natural gas have got a long runway. Nothing's going anywhere anytime soon, and think we can take advantage of some certain pricing scenarios right now to deliver the best return back to our investor base.
Excellent. Well, great. Well, thanks for being with us today, Jace, and we look forward to hearing great things from the partnerships and the oil investments that folks are making. Hey, everybody. So I hope you enjoyed the episode. Those are two of the finest oil men that I know. And there does seem to be an opportunity in investing in energy. Energy demand is only going to go higher. Oil is not going away, even though there are groups of people that want oil to go away. But we're now the largest oil producer in the world. And that's not going to change based on all the new technology and everything. So having energy in your portfolio can be an important thing to do. If you're interested in learning more about that, let us know. Give us a call at 4-Star, 312-667-1750, and we can connect you to an advisor that will show you all the different energy programs that we have at the firm. So thanks, everybody, for being with us, and I hope you enjoyed the episode. We'll be back with another one, market commentary, very shortly. Have a great day.